What are bank earnings telling us? Welcome to Real Vision Daily Briefing. It's Friday, April 14, 2023. I'm Ash Bennington. I'm joined today by Brent Donnelly, president of Spectra Markets. The second half of this show is just for Real Vision members. So if you don't want to miss it, you can sign up by using the link in the description or scan the QR code on the screen. Let's jump right in to today's market analysis. I started the show with a question, Brent. What are bank earnings telling us? Are they telling us, damn, it feels good to be a GSIB?
Yeah, I mean that's the thing is it's the big banks, right? So it's not really telling us all that much. Although if you were short looking for some kind of systemic banking crisis, then this isn't what you were looking for. So, there is some relief. Obviously, it helped equities a little bit. It's meaningful at the margin, but what really matters is what's going on with the regionals. And that's a much slower moving story, which is lending contraction, and it's not like an explosive story the way that maybe equity bears wish it was.
Well, this is an interesting point, and you make a lot of these subtle distinction here between the GSIBs and what's happening in regional banks.
Mm.
The fact that we may still have something of a slow motion crisis waiting out there. But I want to cover just some breaking news here, and this is directly from a great Wall Street Journal piece on the three banks reporting today. They actually went with a similar lead to what I said. It's great to be a mega bank even in a banking crisis. Here's what's happening: J.P. Morgan up on the day, 7.5%, significant move up for JP Morgan on this news, reporting a 52% increase in first quarter profit and record revenue. Some other interesting stuff coming out of JP Morgan. They picked up about 50 billion in new deposits following March's bank failure. Let's also take a look at what's happening with Citi, up 5% on the day, and Wells Fargo, call it basically flat, fractionally down on the day. But all of these banks obviously getting something of a significant tailwind. They're charging higher rates. These are net interest margins, so-called NIMs, while paying depositors basically similar rates. Pretty good model. Nice work if you can get it.
And I would say 7.5% in JPM, that's real money. It's a major market cap change.
Yeah, it's absolutely massive. Let's see if we can get the market cap for JP Morgan here in just a second. $379 billion market cap over at JPM. So Brent, give us a little broader context here on what you see happening in these markets.
Sure. So broadly, I think people got spooked on the Silvergate stuff. Really started positioning for something pretty severe on the lending side. And what we're really seeing, we've got a lot of data in the last 2 weeks. What we're really seeing is something much more gradual. So it is kind of like a negative economic backdrop that's starting to form, but it's not like super black clouds and thunderstorms. It's more like you look over on the horizon, you see some clouds coming in. So then in contrast, if you look at positioning and sentiment, people have been quite bearish stocks. And so the news isn't delivering on the thesis really, like that the shit was going to hit the fan. It's maybe things are getting worse for sure, but it's kind of gradual. And then what it kind of looks like is a bit of disinflation at the same time, especially on the good side. PPI is negative in some countries now. So it's just not that bad. You know what I mean? So we've been oscillating from recession, hard landing, soft landing, no landing. And people don't really like to talk about the soft landing option because people don't like the Fed and people don't expect something good to happen generally. But I mean, it's still possible, right? And I think that's one of the scenarios that the market has to consider. And it's not many people are positioned for that.
Well, let's talk about exactly that. I'm so glad you bring it up, and you're right. It does seem to be a minority view. Let's talk about what the case might look like for a soft landing. How might that be engineered? What are the probabilities? And what would the impact be around that scenario?
Sure. I mean, it's tough because they're trying to thread a needle with still high inflation. And earnings expectations are still relatively high from the analyst side. But at the same time, if you look at, say, 1995, that's kind of what happened, right? The Fed ripped rates higher, people got nervous, a couple things broke, and then somehow we skated through. I think it's much more difficult now because debt is just so much higher everywhere. Like government debt, obviously sovereign debt, but then also if you look outside of the US, consumer debt's very high in many countries like Canada. But then you do have the China reopening, maybe helping at the margin. That creates some global demand. Europe looks okay, not terrible. They've been able to hike rates up to here without killing Italy and destroying the BTP market. So, if fertilizer prices are falling and food prices are falling, shipping costs are falling, all that stuff is kind of a little bit of reason for optimism. And then I would say also, if you think about just like the conversations you're having lately with just friends or whatever, I don't feel like that psychological angst is as much of a thing now in terms of inflation. Like people aren't bitching about menu prices and like how their coffee went up and all that kind of stuff these days. I think we've kind of settled into like a new higher level of prices. But then if the rate of increase slows a bit and the Fed can stop hiking, now there's like I've just said the word if about 10 times here, right? So that's the question is it's like this immaculate disinflation scenario is very tough. It's like Sully Sullenberger trying to land a plane on the Hudson River or whatever. Like, is it possible? Sure. I mean, he did it, but can Powell do it? Nobody's positioned for it. So it's kind of the pain trade, and that's what's happening.
Well, let's talk. That's so well said. Let's talk about exactly that and define a little bit of the parameters and the characteristics of what a soft landing would look like.
Sure.
I mean, let's just walk through some of the basic points here. I mean, the challenge right now, the challenge the Fed always has, is trying to simultaneously balance the two prongs of its dual mandate, maximal employment and stable prices. But the challenge here is that you have problems on both sides of it. Right now, CPI print for the month of March came in. It's been moderating, but it's still 5%. That's 2.5 times higher than their target. I know Fed uses PCE, personal consumption expenditures, rather than CPI, consumer price index, but it's a pretty good index of what's happening in the economy more generally. Simultaneously, on the other side of this kind of balance of terror that central banks always need to navigate is the risk of recession. It now sounds like, based on the comments that we're getting from the Fed, from the minutes, from the commentary, and from the speeches, that there's basically a mild recession risk being baked in by the Fed. How do they balance these two things? I mean, typically the idea is that you have a brake and a gas pedal. If you want to think about this in the simplest possible metaphor, you can't press them both at the same time. We're going too fast and yet we're going too slow. This is a real material challenge. How do central bankers deal with this? What are the implications for markets?
Well, the hardest thing really is that the long and variable lags take a while to kick in. So they've hiked a lot, right? I mean, they went from whatever, 0 to 5 ish. So now everyone's kind of waiting to see what happens, right? Because if you think about the lags are between 6 and 18 months, we're kind of like in the heart of that. And that's when usually things start to break. So now it's almost like you already slammed on the brakes and now you're just waiting to see as you start skidding on the wet pavement. Are you going to slam into the car in front of you, or are you going to like kind of go ding into the fender, or are you going to stop in time? And like they don't know. I mean, that's why if you look at like Goolsbee, he's saying the credit tightening is like 25 to 75 basis points of hikes, like the equivalent of that. Whereas if you listen to Waller, he's just saying kind of like what you said. Listen, inflation's high, unemployment's low. What are we doing here? We got to hike. But the problem is that it's not instantaneous. So that's why there's a really wide range of opinions on what can happen in the economy. And then also, even inside the Fed, like what should the Fed be doing?
Yeah, you used a phrase, a term of art at the beginning of your answers there, long and variable lags. This is something that we hear from the Fed, and I guess in layman's terms, it basically means, there are these delays between policy action and policy results. Another way of sort of framing that specific long and variable lags a little bit more broadly is sometimes when you hear these folks, central bankers around the world, talk about the policy actions that they have, their policy toolkit, it sounds like they're able to very finely turn the dials on the economy. There are lots of folks, particularly on the Austrian side of the economic spectrum, who believe this is something of a fantasy, that central banks can sort of minutely sort of micromanage the money supply, micromanage monetary policy to achieve optimal results. It's not easy.
Well, I think a really important thing that everyone needs to remember is that it's not a science, right? So economics is not a science, and like they can pretend as much as they want. They got 600 PhDs there writing papers with complex formulas and stuff. It's just not a science. Nobody knows. So they're kind of like walking through the darkness, trying to figure out what each thing that they do like what the result is of each action that they take, and then they bump into some furniture, and they have to kind of try and figure it out. So I think they tend to speak with more confidence than is justified because the lags are so long, but then also, like you suggested from the Austrian side, you don't even really know what all the relationships are. And so like a lot of the inflation that we got was probably just related to fiscal. So and then shortages of workers, and there's still a shortage of unskilled workers. So hiking rates isn't going to do anything to that immediately, but then over time it will, because as rates go up, people's behaviors change. So even like the deposit flight thing, really until we got to 4 or 5%, everyone's like, I'll just take zero in my savings, I don't care. But I mean, at 4%, then you look at your quarterly statement and you go, okay, yeah, you know what, this is stupid, I'm going to move into money market funds. So over time, people's behavior will change. And then like in Canada, I say mortgages will reset over time. And so everything that happens on the rate side takes months or sometimes years to flow through to the real economy. And like nobody knows all the mechanisms. It's just wildly complex.
Yeah, extremely complex. I remember about 10 years ago, I was reading a white paper from the Fed, and I found embedded in one of the formulas a third derivative. And I remember thinking to myself, well, two things. Number one, I'm probably not smart enough to be reading this paper. But number two, when you're getting to third order differentiation in calculus, really, does that really describe the way the real world functions, or is it just, overly engineered and beyond the capacity of any human being to understand or model?
Right. I mean, that's the thing, right? Is that it's so complex that sure, there are third and fourth derivative things going on in relationships, but you can't extract them because
Right.
every cycle is different. The starting points matter so much. Like starting from zero rates and going to 5 is completely different from going like 4 to 8 or whatever, because the whole economy was kind of structured for zero rates over the last 10 years. And we had like this secular stagnation and everything. So there's sort of like a joke about saying this time is different, but every time is different.
Yes, that is so true. Listen, while we're talking about this, I wanted to take a look at a conversation Andreas Steno Larsen had on Real Vision, the latest in bank lending trends. This is an Andreas Steno Larsen show on Real Vision, aired 4 days ago. Let's take a look at that because he touches on many of the same points that we are discussing right now.
Monetary policy is to blame for this deposit crisis. And I think it is vastly overlooked that the inverted yield curve and the destruction of dollar liquidity via the quantitative tightening program is the underlying root cause for this deposit flight or this deposit crisis. Let's assume that bank credit overall contracts. Clearly, when bank lending contracts, there will be a smaller amount of deposits available in the banking system as well. So that is what you see on the chart here, the amount of brought dollars available to the financial system, the M2 measure, has declined year over year in tandem with the decline in deposits in commercial banks. And this factor is much more important than the factor I showed you just earlier with people moving money from deposits to money market funds. This is probably, say, 5 to 6 times more important than the move towards money market funds, because this is an actual destruction of US dollars occurring due to monetary policy. And I simply doubt that it is possible to continue to destroy US dollars on an ongoing basis from here, unless the Fed truly wants to break things.
2 points stuck out to me about that comment from Andreas Steno Larsen. The first is that monetary policy is to blame for the deposit crisis. And then he ends with this note, quote, "And I simply doubt that it is possible to continue to destroy US dollars on an ongoing basis from here unless the Fed truly wants to break things." I guess two sides of the same coin. Ultimate point here being that the Fed will continue to, increase rates. This is a story we've heard many times before, increase tightening policy actions until something breaks. Well, something broke. We saw it with the regional banks. Risk of more stuff breaking in the future. Brent, what are your thoughts?
Yeah, I think by definition, that's kind of like they're not really trying to do that, but they understand that that's what's going to happen. People often talk about the inverted yield curve as a predictor of recession because it has an excellent track record. I think it's 8 for 8 in the last 8 recessions. But to me, I think it's also a cause. And that's kind of what Stanos is kind of pointing to there, is that when the yield curve is inverted, a lot of behaviors change, including like how banks are incentivized, and it sucks money out of the system, like he said. And so, to me, that's part of what the Fed is doing, and they're doing it on purpose. But like, their intent's not really to break something; it's just like that's the collateral damage of trying to engineer and central plan a little bit. Is that's what's going to happen on the side.
Well, the intent is never to break something. It just always seems to happen eventually
Sure.
when you take significant enough policy action.
Well, and also they don't really, like I said, that nobody knows like the parameters of what exactly they're trying to get to, because no one knows where R star and the neutral rate is really. And it seems to be pro-cyclical as well. So the stuff breaking is kind of like the evidence that, okay, we're probably in restrictive territory now, and we're probably getting close to tightening enough. And so it ends up being like, kind of looks like they're trying to break stuff, but they're not really. It's just that when stuff starts breaking, that's a signal, or that's information, right? That, okay, things are tight enough now that we're changing behaviors in the real economy or in the financial economy, and then those will go into the real economy.
Yeah, via various transmission mechanisms. By the way, there are many different ways we can take a look at that inversion, but I'm just looking at 2's10 spread right now on my screen, and it's almost 60 basis points, pretty considerably inverted negative, minus 58 basis points right now.
Yeah, I mean, if you look at 3-month 10-year, it's pretty epic. That chart is epic.
Yeah. So let's talk a little bit about what's happening in terms of S&P positioning. I know this is something that you and I were talking about a little bit offline, and you got some charts on this one, Brent.
Sure. Yeah. So the first chart just shows positioning in S&P futures from non-commercials, which is speculators, basically. And if you look at where it is now, essentially, that's about as short as it ever gets. And what that is consistent with is people thinking that a crisis is coming, something systemic is happening. That's a different chart. It's the one that's like a zigzag, like an EKG.
Yeah.
That one. Yep. So you can see it's at the lows. Then if you bring up the other chart with the 1, 2, 3, 4, 5, 6, 7 on it, that shows you, that's just S&Ps with any time that positioning was in the 95th percentile short. So it's maybe a little hard to see, but the gist of it is that pretty much every time we rallied, other than eventually, obviously 08 happened, but S&Ps were pretty much max short from like 06, 07, and then 08. It obviously paid off really well. Those other blue lines are like the Eurozone crisis, China deval, and COVID, which were all like terrible times to be short. So like I don't like to just use positioning in isolation, but then April's the best month seasonally for stocks. So you have like a lot of kind of like technical, more microstructure things that are not in your favor if you're short right now. And essentially what you're cheering for if you're short is a crisis, like a systemic thing that rips through the system quickly, because that's generally what you need when positioning is this extreme.
So let's actually talk about that. Essentially what you're saying is what the shorts are waiting for right now is some event to rip everyone's face off. Is there something that you see that looks like that on the horizon, which obviously would be bad news for the U.S. economy, bad news for markets more broadly, but good for those who are short positioned on S&P?
Well, if you think about like how the S&P reacts to economic data, think of it kind of like a smile. So like on the left is very strong data is bad for stocks generally, or whichever side. And on the right is very weak data is also bad for stocks. But the stuff in the middle kind of keeps the Fed chilling out a little tiny bit. And that's what we've been getting. So I think the other thing besides a systemic problem, say from the regionals, would just be like a very rapid decline in the economic data, like ISM and all that stuff just keeps on cratering, and it has been going down. And then you could get something like 2001, where it's just like a long bear market where the Fed's cutting, but it doesn't matter because the economy is just really, really weak. But we just haven't seen evidence of that. Like the labor market stuff's rolling over, but it's not horrendous. Like nothing is really pointing to initial extreme weakness in the economic data via lending clamping up. So lending is contracting, and that matters, but it's just not like a super hardcore, really fast decline in the data. And so when we're in the middle like this, it's just hard work being short stocks.
Let me ask you this. So obviously, JP Morgan earnings out today, a call from Jamie Dimon and the executive team over at JPM. CNBC just posted this story. There's some comments here from JP Morgan. I was wondering if we could read these and get your comments and thoughts about this. This is from CNBC. Investors and businesses should plan for interest rates to remain higher for longer than currently expected by the market, according to JP Morgan Chase CEO Jamie Dimon. Quote, if and when that happens, it will undress problems in the economy for those who are exposed to floating rates, Dimon said. Dimon said he told all his bank clients to prepare for the risks of higher rates and that it's possible that more smaller banks could fail. So exactly the points we've been making here, Jamie Dimon making on the JPM earnings call earlier today. Thoughts about that? Thoughts about those comments?
Yeah, I mean, I think most people are in the same camp that the cuts that are priced in for the Fed, I mean, starting in June or July, are very aggressive. But the funny thing is, like, not very many people believe that market pricing. It's more like if they cut, they're going to cut a lot. So, say it looks like 25 basis points is expected. Really, it's like a 25% chance of 100 basis points. Like if they cut, they're going to be they could be massive cuts because then there's probably a systemic situation or something. So I think really consensus is that rates will probably stay around here. I don't think a lot of people are calling for really imminent rate cuts, but it's true. I mean, the longer rates stay high, the more pain is going to kind of ripple through the system. And so, I mean, the point's definitely valid. It's just that I think that's kind of like what most people expect, even though market pricing kind of suggests something a little bit different from that.
Talking about differences between what market pricing suggests and what is being said by certain individuals, John Williams, president of the New York Federal Reserve Bank, out earlier this week saying that he thinks one more rate hike essentially would be appropriate based on his view of what's happening. Obviously, all the market-based indicators indicating that investors believe the opposite is going to happen, that the Fed is going to begin to pivot toward cuts. Talk a little bit about that disconnect.
Well, there's actually 70% chance of a hike priced in for May. So it's like the craziest curve ever. It's like a hike
Right.
and then a cut basically like immediately.
Right.
And like I said, I don't know. I find that hard to believe, but maybe they do go into May as like, okay, this is like a final sort of like bone toss to the inflation people. And then they calm down. But we've been thinking that for ages, right? Like we keep thinking that they're done and then they're never done. So I feel like unless we see real evidence of labor market slowdown, which we're kind of maybe getting at the margin, but not enough, then yeah, I mean the cuts look kind of insane, but it's always more probabilistic where like there is a tiny chance of something really bad happening, and so that has to be in there as like a risk premium in the rate side.
Let me add a little bit of color and context from Mr. Williams' comments directly, talking about an additional interest rate hike this year. He says it is, quote, a reasonable place to start, a reasonable starting place. And then he goes on to say, we need to do what we need to do in order to make sure we bring inflation down. We've seen the data come in consistently strong. Obviously, PPI off a little bit of peak. Most people think inflation off-peak increases and beginning to decelerate, but still on a regular basis coming in ahead of where the Fed is targeting 2.5 times by some metrics.
Yeah, I mean, Waller was similar today too, and Waller and Williams are both pretty credible. So to me, that's the path that they're trying to stay on, and then it's just like whether they get knocked off. And Silvergate looked like that moment, and obviously we saw like a massive explosion in the rates market. But now things have calmed down and they're trying to stick to the message as long as possible. And, there'll be a point where they can't stick with it anymore. But I think the Waller speech today was important too. Actually, if you bring up the chart of 2-year yields, you can see the data this week was like on the soft side most of the week. And you can see that's an hourly chart just showing this week. So you can see like their CPI yields came off, but then this morning, I think people were leaning very much for weak retail sales, and it was kind of mixed. And then Waller spoke, and he was quite hawkish. So it's an interesting week from that point of view, in that you got some kind of weakish data overall, but yet yields finished the week higher, and that's not super great if you're bullish bonds Yeah, that's not what you were looking for.
Let me zoom the camera out and ask a bigger picture question about this, a kind of meta point about everything we're talking about. You know, we have these conversations on Real Vision all the time. Sometimes it feels like we're medieval priests interpreting papal cyclicals and church doctrine. Is this the way economies are supposed to function? By, you know, looking at a chart and saying, well, Mr. Waller speaks here, and you see 2-year yields rise there. I mean, is that a healthy way for an economy to function?
I mean, I don't think so. I've written about this before. I think the Fed communication is way, way, way too much. It's just gotten to the point where each governor and each member is speaking all the time. The non-voters are speaking. They're saying different things. Maybe in a world of a crisis where you need forward guidance and you're trying to like pin yields in the back end down because you can't cut anymore or something. But I don't know. I feel like it's just like this cacophonous noise that is not useful. I personally don't think it's useful. I think they're over communicating like crazy, and there's just no point to it.
You know, those of us who have a few gray hairs remember the days of Alan Greenspan, where the only communication you got from the Fed was the thickness of his briefcase that he carried. And CNBC used to set up telephoto lenses to catch him carrying his briefcase down to go and testify at what was then called the Humphrey Hawkins testimony on the Hill. How far we have come.
Yeah, and he used to joke about like, if you understand what I'm saying, then you're not understanding properly what I'm saying. So, you know, they were trying to be intentionally vague to give themselves latitude. And now, I don't know, to me, it feels like central planning or just like, I don't know. I don't know really what the motivation is at this point for so many speeches and so much communication. To me, it just feels like wildly unnecessary.
I mean, you do have to wonder, even for people who are not Fed skeptics and Fed critics, about the nature of an economy that has taken on. I mean, if you just go and look at the size of the Fed balance sheet and compare it to the overall GDP of the U.S., it's just a massive proportion.
Yeah, and I mean, if you think about all the fiscal stuff that happened as well, it does feel like market forces just got kind of like blown out of the water there for a couple of years. And now the market's trying to find its equilibrium again. So like 2021, we had the bubble and everything because there was just so much money being fire hosed all over the place. And now they're trying to take back the money. And yeah, to me, it feels like there's a lot of issues with market pricing and, you know, interest rates not necessarily finding their natural level and things like that. But, you know, all you can do is play the game and as it sits before you and play the hand of that you've been dealt. So I try not to get too bogged down in these like sort of more philosophical things, just because it tends to be like turn into complaining about markets or BS or this and that. But in the end, our job is just to like try and make money.
Yeah, I mean, at the end of the day, it's like complaining about the weather. It is what it is, and you've just got to adjust to the current situation. By the way,
yeah, exactly.
Some live TV back in the envelope, head math, WALCL. This is total assets, less eliminations from consolidations on the St. Louis Fed database. $8.1 trillion right now, the balance sheet. U.S. GDP, about $26 trillion. So back of the envelope, it's about 30%.
Yeah, I mean, the numbers are getting so big now that I mean, human beings can't even understand what they mean. So, I mean, the next time there's a recession or something scary happens, what they're going to be 20 trillion? Like it is kind of mind-numbing at this point, the size of the numbers, especially when you dig into how big a trillion actually is.
Yeah, and it's one of the reasons why I think it's important to look at these as ratios, because people get 30%. 30% of U.S. GDP currently held on the balance sheet of the Federal Reserve.
Yeah.
I mean, it's a really sort of striking and bracing moment when you think about that and understand the magnitude of that change.
Yeah, I think essentially what's happened is that MMT kind of became almost orthodox, right, for a bit. And so the combination of fiscal and monetary extreme policy kind of became like, oh, it doesn't matter. The politicians don't care about deficits. No one ever asked, like, remember back in the day, people would say, how are we going to pay for it? Now that's not even a question. You just announce the stimulus and who cares? Who cares how we pay for it? So I guess the answer to how we pay for it is it's monetized by the Fed.
Yeah. 10 to the 12, a 1 followed by 12 zeros, a million millions. Before you know it, it starts to add up to some real money, doesn't it?
Yeah, it's almost real money at this point.
Listen, I wanted to tell everyone who's watching right now, this has been the first half of the show that we've been doing live on YouTube. We're about to transition to go behind on the Real Vision website for the second half of the show to talk a little bit more and in more detail about some of these points that we've been discussing here. So if you don't want to miss it, you can sign up by using the link in the description or scan the QR code on the screen. And we're going to continue to jump into more analysis right now. Thanks for joining us, everyone who is watching on YouTube. And please continue to join us on the Real Vision website.